The Vietnamese economy continues to shine, outperforming regional peers with impressive 7.6% growth in the fourth quarter of last year, the fastest pace in more than 2 years. This solidifies Vietnam's position as one of the fastest growing economies in the region and a consistent bright spot in ASEAN, a trend we expect to continue in the near term. However, as we enter 2025, we see risk for growth to moderate to around 6.2%, down from the robust 7.1% recorded in 2024. This slowdown is partly driven by a delayed recovery in construction and property sectors, and more significantly, a potential trade headwinds under Trump 2.0 administration. Our earlier studies indicate that Vietnam is likely the most sensitive among ASEAN 6 nations to the higher US tariffs. Exports to the US accounted for 27% of Vietnam's total exports in 2023, and its rising trade surplus positions itself as a potential target for renewed tariff measures under the incoming US administration. To be sure, the scale of the impact will ultimately hinge on the specific trade policies implemented. Despite this risk, domestic resilience remains a key theme in Vietnam's 2025 outlook. Consumption is expected to hold steady, supported by improving labor market conditions, as well as the government's extension of the 2% value-added tax cuts through mid-2025. Rising income levels further support this positive consumption narrative. On the investment front, Vietnam's foreign direct investment landscape remains encouraging. While fourth quarter 2024 registered a year-on-year decline of nearly 30% in total registered capital, the quarterly increase from $9.6 billion in the third quarter to $13.4 billion in the fourth quarter is noteworthy. Encouragingly, the manufacturing continues to dominate investment inflows, indicating continued expansion of future production capacity and reinforcing the sector as one of Vietnam's primary engines for growth in the near term. Additionally, the government's effort to deepen and broaden its bilateral and multilateral free trade agreements have provided better market access for exports and complements the authorities' initiatives to attract more foreign direct investment. Looking ahead, global supply chain diversification trends should keep Vietnam attractive to foreign investors. A recent JETRO survey found that over 56% of Japanese firms operating in Vietnam plan to expand their presence within the next 2 or 3 years, a strong vote of confidence in the country's investment environment. In the more medium term, Vietnam's focus on emerging sectors like semiconductors and artificial intelligence is set to grow. A government decree issued on December 31, 2024 on establishing and managing an investment support fund underscores this very commitment. Turning on to inflation, Vietnam's headline and core inflation edged up to 2.9% year-on-year in December from 2.8% in November, bringing the annual CPI to average 3.6%, slightly higher than the previous year's 3.3%. For 2025, we anticipate inflation to rise moderately, with our forecast at 4.0%, below the parliamentary target of 4.5%. Key contributors include the ongoing effect of public wage increase from mid-2024 and potential imported inflation due to the currency depreciation. However, stable global commodity food prices should keep inflation manageable. In light of these dynamics, we expect the State Bank of Vietnam to maintain a cautious but flexible monetary policy stance, keeping policy rates unchanged throughout 2025.